Okay, I think we're live. Hello everyone, this is How to Invest episode 11. Got a lot of interesting things to talk about right now. So I've written a list here. Some people have written to me with a few questions that they want to talk about. So I've been able to kind of prepare some content here to share with you. But essentially this is how it's going to go, right? So on Fridays at 9 a.m. Eastern Time, I talk about some of the things that have come up throughout the past week in investing, and it's really about how to help you think about your portfolio. That's really what this is about. So I come up with some things that I've either people have written to me, hey, happy Friday, hello, I'm Taylor, thank you so much for joining me, regular person, I assume it's a guy, thank you so much for joining me. Some people have written in a few things, and I've got a good podcast for you guys today. Okay, so I'm going to try to do something here. So I'm going to try and, if I can, someone wrote to me and said, Michael, I would like to understand, just as a beginner, how to look through a cash flow statement. So I'm going to try my best here to share with you a screen, and hopefully this is going to work. My internet is a bit slow. Hopefully this is going to work. So I'm going to show you a cash flow statement, and then we are going to hopefully be able to navigate this together, because this is one of the things that people have said to me, that they would like to understand a little bit more how to read a cash flow statement. So I'm just waiting to see on the screen once that's gone. There's a bit of a latency between what's on my screen and what shows up on your screen. Just need to make sure that's updated. Just a second. Should be coming soon. It's coming. Okay, brilliant. Yeah, we got. So I've highlighted Farfetch because its earnings just came out, and I was looking at its results this morning. So I wanted to just kind of go through that, and that's a good case study for us to look at, okay? So it doesn't really matter too much if you know Farfetch, if you don't know Farfetch, it doesn't make a lot of difference here. We're just really looking at the cash flow statement and some of the clues that you can pick out. Incidentally, the stock is down pre-market about 20%. So if you kind of look at this video after this podcast is up, you can kind of go through and see what are the things that I was highlighting, okay? So I'm not sure if you can get a very good quality, but hopefully if you can kind of look up on page 14 of their press statement, you see the cash flow statement. And what I'm showing you here is you can see that the cash flow from operating activities over the trailing 9 months was negative 400 million versus negative 84 million for the previous 9 months. So even if you don't know anything about the story, you just pick up this, you see that this is a business that is clearly not flourishing, right? It's not a business that is doing something strong, and it's not a robust business. It's clearly a business that is moving in the wrong direction. That's the first thing I wanted to highlight. So that's the first thing you need to look at when you come to any business. When you look at the cash flow statement, look through to see how that top line, so that you can see there are 3 points to the cash flow statement here: cash flow from operating activities, cash flow from investing, and cash flow from financing at the bottom. So the 3 parts, okay? IFRS and GAAP is slightly different in how they lay this out, but essentially, however they label it, there's still going to be 3 parts to it. The first, the most critical part, is how the business gets its cash flow from its underlying operating activities, okay? So that's the first thing you want to highlight. The second thing you need to pay attention to is whether the business, how much they're doing in terms of capital expenditure, which comes under property, plant, and equipment, and intangibles. So you can see there, hopefully on the screen, I'm not sure if you could, but it's approximately negative 130 million of intangibles that they've recognized, that have payments for intangibles. So if you add the property, plant, and equipment plus the amount of cash that went out for intangibles, that's your kind of quote unquote capex. So you take that away from the cash flow from operating activities, and that is essentially what people term as free cash flow. So you want to be able, that's the business's ability to grow. They need cash to grow, and that's just a kind of way to think about whether the business is moving in the right direction, it's stable, or what's happening, right? So obviously in the early stages of the business, they're investing for growth, so they're kind of very aggressively investing, and you expect this to be negative, but over time you expect it to stabilize, and then later on at some point you expect it to inflect higher. The next thing I wanted to highlight from this one here is if you scroll down a little bit more, hopefully my mouse will pick up. Okay, so it's just jump. So you can see here, capital contribution from non-controlling interest. And you can see that they've had the 500 million inflow of cash from a non-controlling interest. So even if you don't understand anything about the business, you can see that the business's cash flows are coming from outside of the underlying business. So you don't need to know anything about the story. You don't need to, don't need to overcomplicate anything. You just need to understand, okay, the business is getting the cash in from something else. So anytime that a lot of cash is coming in from this part of the cash flow statement, which is cash flow from financing activities, you can understand that they're getting their funding elsewhere. So that's some of the things I wanted to highlight for you. One more thing I wanted to highlight, if the mouse will come up, is, let me just scroll back up here, is when you look at the number of shares outstanding, you can see here, they've gone from 340 million in Q3 of 2020 to 470 million in this period this year. So as the number of the revenue has grown by approximately 33% year over year, they've actually diluted the shareholder by 36% year over year. So you don't want a business that's growing at 30% and diluting you at 40%. I mean, that doesn't make a lot of sense as an investor. So you want to see a business that is growing its top line, but the dilution that they're taking out is not that big. That's one of the things that people have written to me and said to me in the past, how do I think about the amount of share-based compensation? So that's an answer to that question. So if you just think about when it comes to investing, you want to see that the amount of stock-based compensation or shareholder dilution or the number of shares outstanding is growing at a slower rate than the top line. So that's one of the things I wanted to highlight. Moving on. A few people have written to me and said that they believe that there's a stock market crash coming in the next month. So one of the things that I wanted to highlight, I can see that my internet is really buffering badly. This is horrible, very frustrating. One of the things that I wanted to highlight is that people have written that there's a stock market crash coming in the next month. Now, I wanted to just say this, right? Of people that could have predicted at the end of 2019 that there would be a stock market crash in 2020 are very, very small. And of those people that could have predicted there would be a stock market crash, it would have been very, very difficult for them to say, when all is said and done, the market will have still progressed over 2020 by 16%. So that's one of the things I wanted to just explain, that it's very easy to be a pessimistic investor. That really kind of sounds cool. It's always so cool to be a pessimistic investor, but it doesn't drive your portfolio forward. So when you think about investing, there's a quote from Peter Lynch that says a lot more capital has been lost in anticipation of the crash than in the crash itself. So it sounds cool to kind of be to try and be like a panic investor, but it doesn't drive. Over time, the markets continue to go up. If you look where the markets were at the top of the dot-com bubble, and you look at where they are 21 years later, it's still higher. So even though you've gone through that cycle of everything materially selling off, it hasn't really been the case that it's gone higher and then it fallen and then it has never returned. It is bumpy, but over time you do really drive your returns by being a holder of businesses. Okay, one more thing I wanted to highlight. So in this earnings season right now, a few stocks are just basically fallen from the sky. I'm just going to highlight two names, Peloton and Roku. And what I see right now is that these are strong brands, and you would never have thought that in 2021, when we started, that these brands would just, their returns for shareholders would have been substantially negative. So the market has been so volatile right now. And someone had written to me several months ago saying, several months ago they wrote me, earnings seasons are going to be increasingly volatile as we go through, because newer investors have learned from Bitcoin that everything is either going to the moon or going down, but over time the price of Bitcoin is going higher. So that's how they've learned to invest, that it's okay to kind of see these kind of cycles, and that's just in their nature now, and that's how new markets are going to go forward over time. And I've seen this a lot happening, and it just reinforces the image that you must be willing to hold on to your businesses with a grip of death, I call it, just a really tight grip. I'll just pause there for a second. So should we expect shareholder dilution with these growth companies? So shareholder dilution will happen. So I explained previously that when it comes to the way that management sets themselves up nowadays, they're not investing so much in property, plant and equipment, so they have their main expenditure of the business is hiring talent. So you're hiring people, and that's the main cost now of the business. But the way that the accounting is set up with the GAAP accounting, it's not reflected that. So in the GAAP accounting, stock-based compensation is kind of reflected on the property on the profit and loss statement. But historically, when people had to build a plant, that would have gone out as capex. So you'd be spending, let's say, for the sake of our discussion, let's say a car manufacturer in the 50s would have had, let's say, $1 of earnings per share. Approximately 40% of that earnings per share would have had to be redeployed back into the business as capital expenditure to build a plant. Nowadays, businesses are much more asset light. You'd have to invest in your management team. So you'd probably still redeploy that 30 to 40% of the earnings as stock-based compensation. So just that the cost gets deployed rather than into a factory, gets deployed into hiring management. So it's an investment in the business. So it's just, that's really ultimately an investment for them to hire the best people. So I hope that answers the question. If I haven't quite answered the question, please let me know. So a few more things that I wanted to highlight here. I'll just change the screen because it's a bit annoying there. Okay, so one of the things that I want to highlight is that a lot of people said, I want to see how my businesses are doing every quarter, and if they're not doing well in this quarter, I'm out and I'll revisit it later on at a better price point. Now, when the markets are very choppy as they are right now, everyone looks like a genius when you kind of sell at, let's say, for 5 or 10% gain, and then you kind of buy back in at a lower price point. But that's very, very difficult to do in real fact, and it sets you up in the wrong way. So the discipline that you should have as an investor is to buy the business and stay invested for approximately, let's say, a year at least. So make that commitment to yourself that I am going to buy a business and I'm going to stay with this business for a year. After a year, you can kind of say to yourself, okay, I thought X, Y, and Z, but it hasn't translated that I've seen this return that I expected. I was wrong because I expected the revenue to be at this level, I expected the profits to be at this level, something concrete. But don't just say, okay, I'm buying it now, I'm very excited, and then they have a bad quarter and you dump that and you go on to something more exciting. Because there's always going to be a more exciting business elsewhere. There's always that new IPO that everyone is talking about, how it's going to disrupt the future of X, Y, and Z. That's not investing, that's just taking a gamble. It's you're going to do much better over time by just buying into a few businesses. You don't need a lot of businesses, but buying into a few businesses that are somewhat diversified, not all necessarily in tech and not all in SaaS. That's not diversification. Because if there's a sector rotation away from SaaS, as we've seen happen a few times already, you're going to be in a really difficult situation emotionally. You're going to be doubting yourself, and the portfolio is going to be down 20-30%, and you're going to be like, oh my God, like, what shall I do? I'm going to exit the market. And that's precisely the wrong thing to do. You're going to be much better off by having a few businesses that are perhaps not doing as well right now, that make a lot of free cash flow, and it just adds some kind of buffer. I call this the hybrid portfolio, but you can, you can do it or you don't have to do it. But the way I do it is that I have a few businesses that are not as cool, but they make a lot of free cash flow, and they give me the ability to sleep well at night, because I know that they may not be compounding at such a fast rate, but you know that those businesses make a lot of free cash flow, and even if things go substantially sour, you're just paying 8, 9, 10 times free cash flow for the business. So it's not a lot that you're paying for. It has a large margin safety, and that allows the portfolio some smoothness, because what you want as an investor is to stay invested, right? So it's just the ability to stay in the game that is really, really important. There's a quote from Peter Lynch that will lead me to the next topic that I want to talk about, emotional investing, which I think helps set up this. So it talks about that when it comes to, let me see if I've got the quote here, 1 second. The quote says, the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story hasn't changed. And this is really what I'm trying to say, that when you kind of investing, you want to try and see where the businesses can go over the next 2, 3, 4 years. That's what you need to do, because in a year's time, you want to see what that person's buying that point then is going to be thinking about the next 2, 3, 4 years time, because that's really where your multiple comes from. Your multiple comes from the people's expectations of where the business is going to go. The multiple is just a reflection of people's confidence in the underlying business. That's ultimately what it is. When you're paying, let's say, 5 times forward sales or 10 times forward sales, or in case of Cloudflare, you're paying 74 times forward sales, it's just how high the conviction of people right now is relative to the underlying business. Are they predicting that the business is going to continue growing at, let's say, a very high rates of return for a very, very long period of time? If yes, the multiple is high. And if people feel that this business is absolutely dire, the multiple will be very, very low. And it's really, in a very short period of time, you can sometimes, it's difficult to do, and that's what I try and do, is you try and buy into businesses where the confidence is low. People don't want to invest in that business, and then you're taking a contrarian view of the stock, and you're saying to yourself, okay, I am taking a contrarian view. I'm saying that the business is worth more than other people believe it is, and you're having to have the stamina to stay with the business. So I'll just highlight one business that I'm really thinking about right now, which is Fubo TV. So in the case of Fubo TV, you're looking at that business, and most people, I don't understand that. Most people will look at the business and say, this business will never be profitable. It's poor economics and whatever. So the multiple is really compressed relative to, let's say, for example, a Roku, where the multiple, even though the share price continues to fall even as we speak, the multiple is still relatively high compared to something like Fubo, in my opinion. You can disagree, and that's absolutely fine, but what you're trying to see is you're trying to buy the business and what the person over the next year is going to be thinking about when they invest. So if I held on longer this year, I'd be better off also choosing quality companies. Yeah, Tesla is just like blew up everything and everyone. I mean, I don't know. I don't know if you guys have seen Rivian. Probably will have had, because it's quite a lot in the media. And I just find it so interesting that everyone has now seen, okay, a Tesla is a $1 trillion market cap business, and because Tesla is 1 trillion, therefore all these other EV companies will also be worth substantial amount. And it's a bit tongue-in-cheek here, but at least when it came to Tesla, they were selling a lot of cars. I mean, in the case of Rivian, I mean, it's nowhere near comparable. And it's just that thing about the expectations, and it's that thing about that I was saying just a few moments ago, that people's perception that the new business is always so much more attractive. But it's very, very difficult to be the next Tesla. It's really, really difficult. And when the expectations are so high, people are paying, could be wrong by the time you watch this video, it could be higher, but I think the people are paying approximately 120 billion for Rivian. And I think to myself, flipping heck, man, like 120 billion, man, that can buy a lot of cash flow from other businesses. And I just, it's mind-boggling. I'll give you an example, right? So PayPal is a lot in the news lately. So everyone is like, I don't want to invest in PayPal. PayPal sucks. And I think to myself, okay, the market cap, I could be wrong here, but I think it's around 300 billion. And you're paying and you're getting approximately 6 billion of free cash flow into next year. And I think to myself, wow, man, that's 6 billion of free cash flow. Rivian is not going to have like 6 billion of revenues like anytime like in the next 3-4 years. So I mean, it's just the distortion that shows up here. And people talk about that that the market is always right, and I also say, okay, yes, the market tends to be right most of the time, but our job as investors is to pick out the 1 or 2 times when the market is not 100% right. And also you have to bet when the odds are in your favor. When you're paying such a high valuation and you're paying, let's say, over 20 or 30 times forward sales for a business, I mean, the odds are not going to be so much in your favor. If you're buying a high quality business and it's growing, let's say 20 or 30 times, 30% year over year, and you're paying, let's say, 15 or 17 times forward sales, that's okay. You kind of, that's fair. In this market environment, that's a fair valuation for the business. You may say, okay, that's too expensive still, but in this market, from what I see, and I follow a lot of companies, this is kind of a reasonable valuation that you're going to get. But if you're paying, let's say, I saw Asana. I mean, Asana was a business that I was highlighting last December. I was saying, oh, people, this business trades for approximately 11 times forward sales. It's really compelling. And I know that I've got some hindsight bias here, but that's not my point. My point is that the business is priced right now at 54 times forward sales. And I think to myself, man, okay, I know a lot of people personally that are really invested in this and really bullish, the management team, ex-PayPal mafia, and I'm thinking to myself, okay, but like the odds, do you have any more significant edge than anyone else coming into this business? Because the new shareholder coming to the business right now is going to buy your shares at a higher price. They must see something that that is worthwhile paying 54 times sales. And I was thinking myself, like, what kind of edge do you have that is not already fully priced into this stock? So I think it's very tricky. And when I get it, right? So there are a few stories that just fully vindicate that thesis of staying. Like I gave you the example of Cloudflare, that when people were saying, oh, it's priced at 50 times sales, like I was saying that was expensive, and then it goes on to 60 times, and then it goes on to 65 times, and I get it. So there are a few cases that can say, yes, that stock was expensive, therefore it's worthwhile buy and hold, great management team, this founder-led business is buy and hold, buy and hold, buy and hold. But I mean, everyone is a buy and hold for as long as the share price is going up. But when they miss a quarter, like I gave you the example earlier of PayPal, when they miss a quarter and the stock starts falling, then people ask difficult questions and everyone gets very irritated and people get very anxious and frustrated, and then it becomes a sell first, ask questions later. And that's what I say. If you're buying, I don't have any position in PayPal, but I'm just saying, if you buy something like PayPal where the multiple is compressed, the odds are in your favor, and you can have you can stay with that business for a little bit of time until people's kind of calmness returns to that stock. And the thing with these stocks is, you've seen right now, they go up slowly over time, and that's cool, but when they have a bad quarter, it falls really fast and just dramatically. You've seen those, like you've seen Peloton, and you've seen Farfetch right now, which is about to open at minus 20 pre-market, and when things go sour, they fall so quickly, and it's just very, very difficult for you as an investor. So try and buy into businesses that have staying power. Try and buy into businesses where the odds are in your favor. If people say, oh Michael, what do you think about cannabis stocks? What do you think about EV stocks? If everyone is getting involved in that sector, it's very difficult to have an above average edge when everyone else is really bullish there. It's much easier in the long term to buy in something like, for example, like a PayPal, where people are not very enthusiastic about right now, and just sitting on your hands for approximately 2 years. And I know it sounds easy to say, and I get it. I'm a practitioner, I'm a serious investor, so I understand that going through that period of seeing your holding diminish in value over the next, let's say, 2 months, 3 months, 6 months is really, really difficult. But at some point, a business that is high quality will kind of come back. It will come back. And the fundamental story hasn't changed. It's just a case of people's sentiment has changed. But sentiment is very fickle. And even if it's towards EV companies right now and cannabis stocks and whatever, it will come back around and people will say, okay, this is a high quality business and it's surprising people because it's actually growing at, let's say, 20% and you're paying a low multiple. I think it's approximately 30 times forward free cash flow. So you kind of think, it's kind of not that bad. So I'll stick around. So this is really what I'm trying to drive at, try and buy into businesses and try and have a bit of a plan that you stick with it. And just before I wrap up, I just wanted to say one more thing, just a bit. This is the last takeaway that I wanted to give to people. When you invest in a stock, just write down 3 bullet points for why you're buying a stock. And one of those bullet points has to include the valuation. Just have, you don't need to be a genius because nobody knows the future. And I gave you the example of Cloudflare that things can be really rational, but just write down, I'm paying the stock 5 times forward sales, or just make a guess at something and write it down. Because when you go through the bad quarter and you revisit a piece of paper and you say, actually, I thought it was cheap at 5 times forward sales, now trading at 4 times forward sales, it's still quite cheap, fine, I'll stick with it. Because just forcing yourself to write that down, you're forcing yourself to think through. But then you have to get into the practice of revisiting that piece of paper that you've written and why you bought the business in the first place. Okay, I don't think anyone wanted to ask any more questions. I mean, it's been such an honor to have you guys around. Thank you so much, everyone. I really appreciate it. Thank you, Taylor, for showing up. Thank you very much. So people, thank you very much. And I just wish to see you next time, next Friday. And don't forget to leave me a like if you like this